Help capture the history of our markets by contributing to the John Lothian News GoFundMe campaign to support the Markets Wiki Education history-focused video series and more.
This entry into the history of financial futures is sponsored by Eurex.
Joined Continental Bank in December of '73 when I got out of the Air Force and worked 2 years in the internal audit department. But during that time, I learned all the accounting that I otherwise should have learned in college and didn't. And also I learned a lot about the documentation for secured financing. And in '75, there was a position that opened up in what was then the Securities and Commodities division in commercial loan. And they were looking for somebody that understood accounting because the accounting standards for the futures industry were just emerging. The CFTC had just been created and it was still in the process of creating the minimum capital requirements for the industry. And any kind of credit was always secured, principally by negotiable warehouse receipts, evidencing product that clearing members took delivery of. So the ideal candidate needed to know secured lending and accounting, and I just happened to be at the right place at the right time. So I joined the Securities and Commodities Lending Division in commercial loan in January of '76, and did that for 5 years through '81, and then in '82. I got the job that I thought I always wanted, and that was to start the futures subsidiary for Continental Bank, and did that until I think September of '85. And then I went to work for Leo at Dellsher Investment Company for about two and a half years as the director of research. Basically, Scott Gordon was Mr. Inside, and I was Mr. Outside at Dellsher. And during that whole time, what's important is during that whole time, I was a member of the exchange. That back in those days, there were four banks, Continental, First Chicago, Harris, and Northern. And the banks all owned memberships on the Board of Trade and the CME. And memberships have to be held in the name of an individual. So the bankers, the relationship bankers, were actually members of they held memberships on the Board of Trade and the CME. The CME had an interesting policy. It might have been Barry Lynn's policy that they insisted that all of their settlement bankers serve on the clearinghouse committee. And by virtue of that over time, they would understand how the clearing process worked and get comfortable with it. The IMM was very small then. And the marching orders that I got from the very top of the house, we don't know what these guys are doing over there. We don't quite understand it. So get involved. That if you're not at your desk in the afternoon, that's a good thing. We want you to go over there, get involved, find out what these guys are doing. And if they're a bunch of crooks, we want to know sooner rather than later. But if they're onto something, if this IMM thing is going to work, we have all the resources of the Continental Bank that we can throw at them to help them, foster the organization. So in 1972, the IMM started on a Chicago Mercantile Exchange, but in 1972, the Chicago Mercantile Exchange was at 110 North Franklin Street. And they had a particularly small trading floor. Basically, it was pork bellies and cattle. There were about 8 currencies that the IMM wanted to trade, and they decided that they were going to trade 12 contract months for each of the 8 currencies. Well, it turns out that the floor manager, on the day that the opening day for the IMM and the opening day for the currencies, the floor manager comes. As Leo and Barry Lynn tell the story, he comes up to him and says, "Well, we don't have that many whiteboards. We actually can't list 8 currencies for each for 12 months." Barry turns to him and says, "Well, then just do March, June, September, and December." And so what happened then is that the third Wednesday of March, June, September, and December to this day are known as IMM dates. And there is literally billions, if not trillions of dollars of financial contracts that are set to mature on the third Wednesday of March, June, September, and December. And as the branding of the CME group overshadows the branding of the IMM, there will be a whole generation of young traders that say, well, wait a minute, why? What are IMM dates? The branding of Globex is CME Group. It's really not the IMM anymore, but everyone knows what an IMM date is. So early on, the senior management of Continental Bank was asked to be the delivery agent on maturing futures contracts. And it became kind of a big deal because as it turns out, the head foreign exchange trader in New York was the incumbent president of the Trade Association of Foreign Exchange Traders. And of course, the cash market foreign exchange traders didn't take kindly to the concept that commodity traders in Chicago were going to start trading foreign exchange. It was basically, they thought it was their purview, and it was that they had a monopoly on that market. Not dissimilarly, the primary dealers didn't exactly take kindly to the concept that the Board of Trade was going to start trading dollar bonds in I guess it was 78. So the decision was made at the top of the house that this was a Chicago exchange and that we were going to support them. So that and what I think what Leo referred to is two things. One is that we were the delivery bank agent for maturing futures contracts, and thank God, from 72 until maybe 77 or 78, there wasn't a whole lot of money involved. As I recall, the first delivery that I had responsibility for, which was probably March of 76. I think it was the total delivery was $53 million. Okay, so that would be a single transaction today. The other thing, and probably the more important thing that Leo refers to, is the concept of a Class B clearing member, a Class B arbitrage firm. And that really helped the IMM. So what it was is that clearing members could call them subsidiaries. They were small clearing firms that could only trade foreign exchange, and they could only trade cash foreign exchange with a single bank. So what they would do is in order to create some kind of a mechanism between the futures market for foreign currency futures contracts and the cash market, the real market for foreign exchange, the concept was developed that they would create these Class B arbitrage firms. So what would happen is an order would come into the pit. And by the way, at the time, the IMM was about twice the size of this room, and there was probably 100 people in there. And so what it was is a retail order would come in, and if they wanted to buy, then the floor broker would shout out what the contract was, and these Class B arbitrage firms would jump on the phone and then call up banks and say, what's your offer to me? And what they would do is they would try to take a tick or a half a tick difference, and so it worked that way. What was interesting at the time is the IMM currency contracts were designed in a way to have a fixed price tick. But that's not the way foreign exchange was traded then. Foreign exchange in the cash market was traded in European terms. So in some cases, the arbitrage was less than an IMM tick. That is to say, if a tick in Deutschmarks was $25, it was always $25. But in European terms, it was how many Deutschmarks can you get to $1, and that changes as the price goes up and down. So there was always arbitrage up, and it kind of worked. What was also interesting is during this period of time, the cash market for foreign exchange was basically five ticks wide until 8 o'clock in the morning when the IMM opened, and then the cash market collapsed to being a one tick market because of these Class B arbitrage firms, and because the IMM started getting some decent volume, and so that the market eventually grew, and a couple of things happened. The open interest grew, the volume grew, the size of the deliveries grew, but the other thing that happened is Paul Volcker became the chairman of the Fed, and interest rates went very, very high. The prime rate actually peaked at 21.5%. And so the value of overnight money, it became quite substantial. What happened was in 76, a guy by the name of Milt Stern, who worked at the CME, came to me with an idea for first we should talk about how deliveries were made prior to 76, because it was less than perfect, shall we say. The clearing members at the CME would figure out what their final positions were on the Monday before the third Wednesday, and they would get the information, the banking information from the buyers and the sellers, and they would bring that information over to Continental Bank, and foreign exchange operations would send telexes to all of the buyers' banks and sellers' banks. You have to realize back then that the medium of communication among banks, especially in foreign exchange operations, they were 300 baud telex machines. So if you were to Google Edward R. Murrow, that the machine that's behind him on black and white television, that's a 300 baud telex machine. Continental Bank would send out these telexes. It says on Wednesday we want you to charge the account of Joe and pay the account of Martha at this other bank. And it was pretty hilarious that any one of three things would happen. Either the seller's bank would telex Continental Bank back and say, you have no authority to tell me to charge this account. The other thing that would happen most often is they would misconstrue the instruction, and rather than charging the account of Joe being a seller, they would charge the account of Continental Bank, and they would pay the currency to the buyer. The other thing is they would actually do it right.
Right.
And occasionally they would charge the account of Joe and pay Martha, because over time they get used to the fact that, oh yeah, this is one of those IMM deliveries. This is kind of screwy. And we'll just do it that way. This worked well and until about 1976. And so about 1976, between the bank and Milt Stern and myself, we came up with an idea. It was really the first delivery versus payment of foreign exchange. It just wasn't the same day. It wasn't instantaneous delivery versus payment the way that it is today. So if you were a buyer, you had to pay your dollars on Monday for all currencies except Canada and Mexico. And if you're a buyer of Canada or Mexico, you put up your dollars on Tuesday for delivery on Wednesday. By doing that, the exchange knew that all of the buyers were good as buyers, but we didn't know if the sellers were good. So the idea was that Continental Bank would open an account in the name of the IMM at all of its foreign branches where it had branches, and we had branches that operated everywhere but Canada and Mexico. So what would happen is on Monday, the clearing members would figure out what their final positions were. That information would be sent over to the bank. The bank would send telexes not to every bank in the world. We would send telexes only to our branch in those countries. And there'd be two telexes. Here's the received telex. Expect all these payments from these banks, and on Wednesday, pay all these customers at these banks. Well, because the longs were known to be good at the opening of business local time on Wednesday, the banks would hit the national payment system with all of those payments, and all the payments would go out. At that instant in time, the Continental Bank branches would be overdrawn at the central bank, but the bank would be secured by cash back in Chicago because no one got paid yet. So then as the payments come in, that would whittle down the overdraft. And at the end of the local business day, for instance, like in Tokyo, we would get a telex back that read something like, all payments received except transaction number 47. This particular firm failed for 15 million yen. And so what Chicago would do is we would pay either the clearing member, or we would pay to the order of the clearing member of all the sellers except the seller for transaction number 47 in yen didn't get paid. And the reason for that is because if you think about it, the IMM's account in Tokyo at the Continental branch is overdrawn at that point, 15 million yen. Well, but it's collateralized by the dollars that the seller would have got if they would have delivered on time. And so this worked really well with a couple of nuances. One is this required a high degree of exactitude on the part of the clearing members and the clearing members' customers, which they were not used to. Back in the mid to late 70s, when payments were made in non-dollars, they were often made, I should say, they were usually made late, but they were made with interest. So if I'm supposed to pay you on Tuesday, I'm going to pay you on Friday, okay? But I'm going to pay you with interest so that when you take into consideration the interest that I'm paying you on Friday, your bank will actually post the credit as though I paid you on Tuesday. So, and that's the way business was done. So the IMM comes along and says, no, you have to do it right. You actually have to do it on Wednesday. Well, this was heresy. And so it took a while, and it took a fair amount of fines to get the clearing members to get their customers to actually do it right. And in order to do it right, the customers had to divulge the name of their bank, the account number of their account at the seller's bank, and the name of an individual at the seller's bank. And some of the clearing members just, they were not inclined to lean on their customers to get all this information. So, from 76 through part of 77, it was kind of an iterative process, trying to get the clearing members to do it properly and trying to get the clearing members' customers to do it properly. And during this time, the value of money went up substantially. So Continental Bank would invest the money that came in on Monday, and so that the buyers of currency, obviously they had borrowed money at probably the prime rate to post that money on Monday. Excuse me. When the delivery was finished, the Continental Bank actually paid the IMM not only all the money that came in on Monday, but paid with interest. So that money went back to the buyers to diminish their borrowing costs so that they could participate in the delivery. I do remember it had to have been 1976 that the very, very first delivery that we did under this new regime, that there was all of the contracts were delivered properly, except there were 10 contracts in Dutch guilders that were not delivered on time. And our branch in the Netherlands came back and said, we got everything except this particular firm failed to deliver 10 contracts. And as I recall, the Dutch guilders didn't even come in until the following Tuesday. They came in with value. Okay, so the paying bank paid the branch with interest so that the bank could have posted the credit as though it was received properly on Wednesday. So this created the dilemma of do we say that they made good delivery when they screwed up or not? And so fortunately there were three of us. Three of us as members were members of both the Clearinghouse Committee and the Foreign Currency Committee. And the three of us constituted a subcommittee called the FX Delivery Subcommittee. And we basically said, no, you screwed up, because that particular clearing member wanted the interest on the dollars all the way back to Wednesday. And we go, no, we're not going to, the bank is going to pay the exchange the interest, but the exchange is not going to pay you the interest because you screwed up. It took a lot of discipline to do this, and it did so in an environment where there's behavior modification on the part of clearing members and the clearing member's clients. And it's also in an environment where the value of money, whether it's Deutschmarks or Dutch guilders or US dollars, the value of money was very, very high. The obvious, it should be obvious to the audience, but maybe not the young people, is, this is years and years before the euro. These contracts were for Dutch guilders and Deutschmarks and, all those currencies that don't exist anymore. These are the contracts that were then being delivered. The other nuance, a bit of a problem, is the cash market for foreign exchange settled in next day funds. That the dollar side of foreign exchange contracts settled on chips, and chips was a next day fund netting system and settlement system. So on Wednesday, basically chips would net payment obligations, and then on Thursday morning, the banks that they would pay their net obligations of Wednesday in same day funds, or what is known as Fed funds. The IMM, all the transactions on the IMM were always in same day funds or Fed funds. And so because interest rates were so high, there was some gamesmanship played every once in a while. That I remember there was a large metal trading company that they bought a very large amount of Swiss francs in the cash market, and they delivered those Swiss francs against maturing Swiss franc futures contracts, knowing that they would get same day funds on Wednesday, and that they could invest that money Wednesday night. And the profit motive for the entire transaction had nothing to do with Swiss francs. All it was to try to capture, was probably an overnight interest rate of 18% on what was probably $300 million. And at some point, we said, well, you're clogging up the delivery with these kinds of transactions. And what came back was, it's not illegal, and so we're going to do it. All of that worked pretty well until about 82, 83. The deliveries had gotten into the billions of dollars. So what the IMM had always done is they had called the primary dealer at Continental and done a repo on all of the dollars that came in on Monday from the buyers. U.S. Treasury securities were not as plentiful as they are today. As a matter of fact, if you go back through history, you'll find people that actually described the delivery of 90-day Treasury bill futures on maturing T-bill futures contracts was actually a problem. It was that particular delivery was a one-day delivery. And the T-bill auctions back then weren't that big. There was a guy named Boris. I forget what Boris's last name was. The guy named Boris was the collateral guy at the primary dealer desk at Continental. He has to call up other dealers and borrow, $2, $3, $4, $5 billion in Treasury securities in order to collateralize this RP, representing all the funds from the buyers. And it got to be problematic. And it got to be problematic because the market knew this was going to happen every March, June, September, and December. And so the price of collateral got, shall we say, artificially high, which meant that the rate that the IMM was getting on their overnight investment got artificially low. So I went back to them and said, well, this isn't customer segregated funds. These are funds to actually make or take delivery of a product. You don't have to do an RP. And so I said, well, just do a 2-day Nassau time deposit with the bank. And so they started doing that, and it worked fine for 2 or 3 years. The problem, and back then the Continental Bank had a credit rating equivalent to that of Morgan Guarantee Trust, and it wasn't a problem. Then what happened was there was a deposit run at Continental Bank in April of 1984. And that was the start of the demise of the bank. And so people said, well, wait a minute, we got $2 or $3 or $4 billion in an unsecured Nassau time deposit with Continental Bank, whose name is being disparaged, daily by the financial community, not knowing exactly what the outcome is going to be. Two things happened. Rick Kilcullen was the president of the exchange then. And he created what the equivalent of a 2-day letter of credit is called an order to pay. So that rather than putting up dollars, rather than having the buyers put up dollars on Monday, you would go to a bank and you would get an order to pay. And the order to pay, functionally, it was a letter of credit. And it basically said, I Bankers Trust, I unequivocally agree to pay Continental Bank, by 10 o'clock in the morning on Wednesday, X hundreds of millions of dollars in Fed funds. And there's absolutely no recourse I have not to pay. Okay, so that substituted the dollars that used to come in on Monday. The other thing that happened was that other banks got involved as currency delivery banks. I think, but I'm not sure, that Citibank and First Chicago came in, and what the exchange did is they said, okay, Continental, right now you're delivering eight of the currencies, and we're gonna give Deutschmarks to First Chicago, we're gonna give Swiss francs and sterling to Citi, and you're gonna keep everything else. And that worked fine. The pricing also changed. I remember when we first did it, Marty McCauley was the liaison in Chicago for all the foreign exchange people worldwide, and it was he had to persuade all these branches to even participate in the IMM currency deliveries. And so the deal was that they were going to get paid $25 per transaction. Okay, it was just an arbitrary number. Well, back then, transfers across the indigenous payment system of the Netherlands and Germany and other countries like that, the fee to make a payment, it was like, it might have been 5 marks plus 5 mils of the value of the transaction. So if the value of the transaction was large, the bank actually got paid a fair amount of money to make the transfer. It was, shall we say, heretic for these branches to say, yeah, I'll do it for $25 a transaction, regardless of what the size was. And Marty talked him into doing it for $25 per transaction. Well, it turns out that as time passed, that wasn't working particularly well either. And so I remember it might have been the late 70s when, and Continental Bank was still the only agent bank at that time, the fee went to $1 a contract. And then as the delivery went to $4 or $5 billion, $1 a contract actually started to be a fair amount of dough. And so the other banks, when it became time to get other banks involved as agent banks like First Chicago and Citi, it started to look like a pretty good deal, because by that time the IMM was an established exchange, the process was established, the behavior modification with the clearing members and the clearing members' customers was established, and $1 a contract was actually a pretty good deal. What Leo really referred to about is how Continental supported the IMM in the early days. It was supporting the Class B arbitrage concept as an arbitrage bank, and also being the delivery bank. And it's good. It's good that in '76 that Milt Stern and I put together this delivery versus payment mechanism, because after that the deliveries got quite large, and it would have been, shall we say, tenuous for the deliveries to have been $2, $3, $4 billion, and to have attempted to do it the old-fashioned way, where you just send telexes off to banks and say, yeah, charge the account of Joe and pay Marcia at a bank and have them, but by this time transactions were in the hundreds of millions, single transactions were in the hundreds of millions of dollars. And to have one of those transactions go awry would have been detrimental. So what the branches would do, these telexes would go out on Monday night Chicago time, and so they would be there opening of business Tuesday in Frankfurt and Brussels and Amsterdam. And what the people in those branches would do is they would look at the largest transactions that were coming from the sellers. And what they do is they'd call up the banks and they'd say, hey, tomorrow's an IMM date. I got you delivering 200 million Deutschmarks here by order, Unilever. Do you have it? Do you have instructions to pay me 200 million marks tomorrow? Da, 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 da. And what they would do is they would reconfirm, if you will, all of the transactions that would have been large enough to screw up the delivery. If there were a failure as a short, it would be notwithstanding a Herculean effort on the part of the branches to have verified that the payment was supposed to come in. And so it worked. It worked well. And there was some gamesmanship played between next day funds and same day funds. But I think it was 1982 that chips went to same day funds rather than next day funds. And so that game was actually eliminated, I think, in 82. It had to have been part of a December delivery, because I remember I requested it, making a presentation to the board of governors of the exchange, and I remember distinctly that it was January when I did that. So what happened was there was a clever gentleman in Canada, time and place setting. Interest rates are extremely high. Let's just say overnight money is at 19%. So what he did is he fabricated some cashier's checks, and they looked really, really good. He called up, he contacted, over time, he contacted 4 or 5 CME clearing firms that still had Grandpa's name on the door. And he basically said, I want to open an account with you. I want to get long Canadian dollars for delivery in December, and I want to pay for them right now. And he did this like maybe a week to 10 days before the delivery. Well, since money was worth so much money overnight, these firms jumped at the opportunity. They opened an account, they executed long Canadian dollar futures in December for the expiring contract, and they thought they were getting a good deal because they invested all this money, and they were going to get to keep it. Well, it turns out that the whole thing was bogus, and that he had given his delivery instruction was, I want my Canadian dollars to be delivered at this bank. He had already given instructions to that bank to transfer the Canadian dollars to a bank in the Bahamas. And so what happened was that the treasurer of Lind Waldock got a hold of one of these cashier's checks, and he called up the clearinghouse manager, who I think at the time was Kathy Munn, and said, that doesn't look like a cashier's check. There's something wrong here. And so the CME brought the check over to the Continental Bank. We showed it to the commercial tellers. They're going, I don't know. That doesn't look very good. So what happened then was the CME clearinghouse then polled all of the CME clearing members and said, do you have an account for this guy? And it turned out that 4 or 5 of them did. And they were all standing for delivery. And we're talking a total, as I recall, there was nine numbers in the number. Let's just say it was $300 million. It would have been probably more than the exchange could have survived. What happened right off the bat was Continental Bank just took control of the situation, called the FBI. The FBI called the Royal Canadian Mounted Police and explained what the situation was. Well, I had to explain what the IMM delivery system was in order for them to understand how the fraud could be perpetrated. And so, I kind of thought that would be the end of the deal, but it wasn't, because in order for us to charge this guy and put him in jail, we actually have to let him commit a crime first. And he actually hasn't committed a crime until he actually gets the Canadian dollars and gives us instructions to transfer them to the Grand Cayman Islands. So what we had to do is we all got together, had a meeting of the minds. What happened was the guy got arrested, and as far as I know, he got himself an orange jumpsuit. But I went back to the exchange. You got to remember, Continental could not operate a branch in Canada or Mexico at the time. So I said, I really need to talk to the board. This is a problem. And so I remember going before the board of governors, and at the time, the vice chairman of the bank, of Continental Bank, was a public governor on the board of governors. So here I'm like a 29-year-old junior banker. I think my title was banking officer, And I'm 16 feet away from the vice chairman of the 8th largest bank in the world, who I work for. And I basically said, look, we got a problem. And what we need is we thought the Canadian Parliament was going to let U.S. banks operate in Canada, and they never got to that legislation. So it's not going to happen. And the size of the Canadian deliveries is now big enough that we got to fix it. We need to get a Canadian bank involved. And so I think it was Leo, or I forget who was there. He said, "Well, McP, you're a member of the clearinghouse committee. You have our authority to not on behalf of Continental Bank, on behalf of the CME. You have our authority to go to Canada and negotiate on our behalf and at our expense." And so I said, "I'll do that, but I need Heckinger." At the time, Heckinger was the manager of the clearinghouse, and he had worked at the Trans-Canada Option Clearing Corporation. Worked in Toronto, spoke good what I'll call French Canadian. And so Rich and I took off to Toronto and called on, there are only 5 Canadian banks. So we called on them, and we came back with a winner, that the Bank of Montreal agreed that they would become the agent bank for the exchange, so that the delivery versus payment mechanism could be established in Canadian dollars. And that relationship operated very well. That the dollars came in on Monday. We opened a cash collateral account for the benefit of Bank of Montreal, so they knew all the buyers were good. And the payment system in Canada works extremely well because there's really only 5 banks of huge size, and they shall we say they designed the payment system so it works really well. And it was scary. It was. I remember the guy had the cojones to actually call me up. This is the crook. Okay, so here's he's not a customer of the bank, and so part of the charade was we had to persuade this guy that he was going to get paid, otherwise he wouldn't commit a crime, and they couldn't convict him. So I remember he called me up, and so I said I'm looking at the settlement sheets. I got you along 40 contracts through this firm and this firm and this firm and this firm, and it's already Tuesday. So as far as I know, the delivery is going to go off. It's going to go on as scheduled. That's what he wanted to hear. So it was one of those near misses that was never publicized. And I remember telling the CME board, I said, the good news is there's only about six human beings in the world that know the weakness of the system, and they're either at Continental Bank or they're at the CME. And then so well, that's good. So we fixed it. There's you could probably write. It would be a very thin book, but there have always been near misses, shall we say, in the clearing space and in the being a commercial banker to the industry back in the I'll call it the wild west days.
John Lothian News would like to thank those individuals who have contributed to our Markets Wiki Education GoFundMe campaign. Their financial assistance allows us to produce and distribute videos like this for our Open Outcry Traders History Project or the Path to Electronic Trading video series. Join them in supporting John Lothian News, capturing the history of our industry.